Over the last few weeks, one of the topics most of the property investor was talking about was the federal budget. I looked at a lot of articles, various websites. Today, I'll just do a quick summary based on what I found out for myself. What are my opinions on the federal budget announcement, my learning from there. Hopefully you will find that useful as well. Now, I don't know about your personal finance situation, so please do not take this as any sort of advice from me. It is simply me sharing my point of view of what I have learned. Hi everyone, Steven here. Welcome to Elevation Educations. So the first thing first is negative gearing. I don't know why everybody was so about negative gearing. The fact is, I don't make good use of negative gearing at all because I believe in positive gearing. I believe in paying tax on the money that I make with properties. Now, negative gearing is not being removed. It's just been changed a little bit. Now, the investor can still accumulate losses, but what it doesn't allow you to do is you can't offset that on the year that you incur the loss itself. So you can't actually offset against your PAYG or your other salary incomes. So instead, what happened is that the losses can be carried forward. It can be offset against your future rental profits, and it can also be used against your future capital gain. So in a nutshell, the tax office doesn't want to give you the money back right now, but they can give you back towards the end of the life cycle of your property. So when you sold it, for example, and you can actually take care of all those expenses and loss, gain, and offset each other. So tax office try to keep more money to themselves instead of giving you back the money. So in a way, I think it's a form of revenue. I won't say grabbing, but it's just more the tax office trying to retain more revenue themselves so they don't have to paying out money to the investors. So what this actually means is this actually create a deferred tax benefit instead of an immediate tax refund. As far as the investor is concerned, it basically means that the investor who is looking for the benefit of tax deductions, a lot of those investors will back off. Again, like I said, I don't understand why somebody will lose $1 to gain back 30 cents, but that's just what some of the other investors was playing the strategy on. So cash flow management will tend to become more important moving forward for a lot of the investors, because you can't get back those losses on the actual day. So the investor will become very cautious about all the outlays that they're going to have. So what it also means is a lot of the investors moving forward will start to look for asset that gives quality return. Either there's a capital growth or there is good cash flow, then those assets will become more attractive. Now the second thing is CGT, capital gain tax. Now the 50% CGT discount is proposed to be abolished for all the future gains after the July of 2027. So what that means is if you already have a property right now, all your capital gain up to the July 2027, you're still entitled to the 50% discount on your CGT. Anything after the July 2027, your capital gain will be calculated as a CPI indexed calculation method. What that means is the value of your property will increase by the CPI value, and whatever gain that you have on top of that will be subject to capital gain tax. That's my interpretations. Anyway, because this is grandfathered, what that means is the current investor that already have their existing property from however long you had, all the capital gain up to the July of 2027, it will follow the old rule, which is 50% discount on the CGT. Anything after that, it will follow the new rules. So what will happen most likely is that around about the July 2027 timeframe, you will see a lot of investors getting valuation done on their property so that they can lock in the capital gain that they had up to that point. They will take advantage of the current CGT discount that the investor have. Anything after that, it will be subject to the new rulings. As far as I'm concerned, it doesn't really impact me, but for some of the investors who just doesn't like uncertainty, they may want to sell it before that date. What the government trying to do is they're trying to separate the old gain from the new gain, because all these ones are grandfathered, okay? Now, the last change, which is very, very important, is the trust structure change. I think what has been worrying in the past was all the family trusts that was formed before. The government or the ATO sees that as a way for taxpayer to pay less tax. And the way that can be achieved is because when you set up a trust structure, you can distribute the profit of the trust onto your other family members, especially like, for example, you have a non-working parent or you have adult children that is not having a full-time income. So you can actually distribute your profit from the trust to this individual and pay less tax on the profit that you actually made from the trust itself. So I guess in a way, the government trying to get more money again from us. By having that changes, what it means is people will no longer see the direct benefit of distributing to the family members. What was being proposed is all the profit that we make in a trust, they just take 30% tax on that first before you can even distribute. So they basically get you first before you can do anything else. So in a way, they restrict the profit being distributed to the lower income family members. So what that really means is the trust will become a less attractive tax minimization strategy moving forward. So people won't do that. But trust is still very useful for asset protection, estate planning, and ownership flexibility. So if you want to inherit your property, like intergenerational wealth transfer and management and control, people still using trust for that purpose. All right, so I think that 3 points helps you understanding what's happening with the federal budget announcement. As far as I'm concerned, negative gearing doesn't really impact me so much. Let me see what I missed. Oh, in regards to negative gearing, what they basically say is from July 2027 onwards, the negative gearing will no longer apply to existing property. It will still apply to new build. So all the new build property, you can still apply your losses in the same year against your income. But for existing property, anything that you bought from the budget night onwards, you were no longer able to claim negative gear from July 2027 onwards. So what that means is if you currently have property, you can still claim negative gearing up to July 2027. After that, you can't claim on the actual year, but you can actually accumulate your loss so that you can offset your future profit from there. Okay, hope that makes sense, everyone. I run an education program called Elevation Education, and the purpose for what I do is I'm helping professionals getting out of their 9 to 5 using properties and also doing side hustles. Now, the way that I make use of my property is turn those property into positive cash flow property. That way, all your properties are not draining your capital or draining your income, but in fact, it will give you money as a form of passive income. So some of the example of my properties are like the co-living property, where I will have a positive cash flow coming from there, and there will be other type of solutions like rooming houses will also give better return than a normal rental return. So those are just on the property front, and on the side hustle front, I teach people how to build businesses that can replace their salary income. So the way I did it for me is 13 years ago, I started this journey of trying to get out of 9 to 5. And what I ended up doing is I was building 3 businesses that gives me 40 to 50K each. So by combining all 3 of them, you have about $120,000 to $150,000 of passive incomes from those 3 activities. I'll give you some example. One of the activity could be a commercial property where it pays me about $45,000 a year net. And another one could be a businesses that you can run online. When you're working full-time, you can run this business part-time, and that gives me about 50K of income. And then you can have other type of businesses like investments or some type of activities that gives you return, that again, you can build up 20 to 50K of those incomes. So altogether, this sort of 3 passive income. Once you have that ability to generate these incomes, you can have the choice to say no to your full-time employment. So this is what my education is believing. I'm helping my younger self to get out of the rat race quicker so that you don't have to get stuck into your 9 to 5 jobs. And with the news that we're hearing about AI replacing all the jobs, I think having a backup plan is so much more important than relying on one company that is paying all your living expenses. So instead of relying on one company paying you everything that you need for your mortgages, for your loans, for your children's school fees, for all your expenses and so forth, I think that's very dangerous to have one point of reliance or one point of failure. I would rather build another form of income source that can literally help me to slowly get out of the 9 to 5 that I was at one point stuck in. So hopefully that makes sense. If you want to find out more about what I do, you're more than welcome to join any of my group. Links are down below. My education program again is called Elevation Educations, and I have some free training resources that you can join as well. There's a 7-day free workshop that you can join where every day only takes you 30 minutes to learn. There is also a couple of other workshops that is free that you can look at. In there, it will teach you about my philosophy of how you can break out of your 9-to-5 using properties and doing side hustles. I hope you find this useful, and I'll see you in the next video. Bye for now.